Our private equity clients really need to look at the balance between M&A activity and organic growth and understand, what is the right mix. And I spend a lot of my time, looking at this with them and helping them better understand. And the best way I look at it is for every dollar that you're going to spend, where's that return going to come from? In today's M&A market, it's very difficult to justify the valuations that you have to pay in order to win some of these quality assets in the market. On the organic growth side, part of the issue is that every dollar that you're investing, there's some runway that needs to be allowed. You're not going to make a investment today in digital technology or data analytics or a new facility or a new product line and expect to see an immediate ROI on that. So it's really taking a look at, if we spend this dollar today, what are we looking at 1, 2, 3 years down the line, and figuring out the best way to balance that. But what we're seeing, given the valuation in today's market, the return can be significantly higher for the longer-term growth of that business, and for the private equity firms, the exit value, by focusing on fixing what's broken within the portfolio company in terms of people, processes, technology, looking at new innovative ways to drive growth, whether it's new geographies, new products, really just getting into new markets. And we're seeing that those areas where we can really focus on the organic growth, strengthening the business, creating more efficiency in the business, those are the ones where they're going to get more bang for their buck longer term, and for the private equity firms help improve that exit value. I think it's definitely fair to say that private equity firms tend to really lean towards an M&A strategy in most cases. It's in their DNA. When you think about the strategy of a private equity firm, it's their bread and butter to look at acquisitions and transactions. There's capital that's set aside for each deal that they do for add-on acquisitions and additional investment in that business. That's how these firms were really built. That's the expertise that they have. But I think that's a mindset that really needs to be looked at very closely, particularly in today's market, where, again, we have high valuations. It's much more difficult to get these deals done. And if you're a platform business that's trading, or that could be valued at 7, 8, 9 times, but your acquisitions that you're looking at are well north of 9 times, it becomes much more difficult to justify those deals on an ROI basis versus looking at investments that a business could make to expand and really drive organic growth. Well, private equity firms can best prepare themselves for what's ahead, regardless of where the market is going, by focusing on their portfolio companies, not just looking at growing the businesses through additional acquisitions, not relying on the M&A market to remain stable or for valuations to remain where they are, come lower, but really focusing on how do you drive efficiencies at the portfolio company level. How do you better understand your portfolio companies, where the growth opportunities are, and rather than dragging your feet, move forward and work with those management teams to really implement change. Be innovative, look at new markets, look at ways to improve the efficiency of the existing business, and leverage new processes, leverage new technology, make sure you have the right people. It's really planning for the future. There's some private equity firms that look at their portfolio and describe it as what they would call recession-proof. That can be a combination of having the right mix of portfolio companies and having portfolio companies that are hedges against each other. But a lot of the firms look at them and say, we're in a slow market. We're going to focus on strengthening our business and really creating long-term stable cash flow by creating a real efficient operation that can survive in any market.